Costing. Q Club Limited manufactures tags for luggage with GPS tracking. During the month of May, they had the following transactions occur. We are asked to prepare the journal entries for the above entries, for these above events. So we start off with transaction A. Some raw materials were purchased on account. So record this by debiting that inventory account, raw materials, for $32,175. We credit accounts payable because it says they're purchased on account. So we use that liability account, accounts payable, to record the purchase of those raw materials. So for $23,175. Part B of the question, it says that raw materials totaling $19,000 were recognition for use in the production. So that means that they've been taken from the storeroom and they've started to be transformed on the factory floor into the product. So we debit a subsequent inventory account, which is work in process. So this is the inventory account to recognize those goods that are being transformed into a finished product. So we debit work in process for $19,000. We credit raw materials because we're transferring it out of that account, $19,000. So the event that happened in Part C, direct labour payroll for the month was $17,850 with an average wage of $8.50 per hour. So Part C, we debit work in process for $17,850 and credit wages payable $17,850. So this direct labour is being used to transform the products. So we need to we're capitalising it. We're transforming that wages into the effort that we use to make our products. So that's why we debit an asset. We credit wages payable because it's still owing and we'll pay it subsequently. Part D, it says that the factory overhead is charged to production at a rate of $7 per direct labour hour. That means our activity driver is direct labour hours. So we need to multiply that $7 by the number of direct labour hours. To calculate the number of direct labour hours that we've used this period, we take the amount of direct labour that we pay for in the previous step, $17,850. We divide it by the average wage, which is $8.50. So that's the direct labour hours per hour. So this is going to give us the direct labour hours multiplied by the overhead rate, $7. This gives us overhead of $14,700. So we debit work in process, $14,700, and we credit overhead control, $14,700. So Part E, we're told that the actual overhead was $15,500. We find out this much later. The earlier step is the applied overhead, which we can calculate as soon as we know the actual hours, direct labour hours. And that actual overhead, we're told, composed of factory rent, $9,500, factory electricity costs, $2,000, and depreciation on factory equipment, $4,000. So the journal entry that we record this, we're going to debit overhead control account because that account accumulates all of both the applied and the actual overheads. The applied overheads we did in the previous step, that's recorded to the credit side of the overhead control account. In this step, we were going to record all of those actual overheads on the debit side of the overhead control account. So we debit overhead control and we credit rent payable, we credit electricity payable, and we credit accumulated depreciation factory equipment. The amount that we debit of overhead control is the sum of all of those actual overheads, $15,500. And what we can then do is reconcile later on the actual and applied overhead and determine if there's been any variance. so where the actual was equal to applied. Part F says that the completed units costing $36,085 were transferred to finished goods. So to transfer to finished goods, which is an inventory account, we debit finished goods, $36,085, and we credit the work in process to transfer out of that inventory account, $36,085. Part G of the question says that some tags costing $30,000 were sold on account for $36,000. So we can record the sale of these particular units. So we debit cost of goods sold, $30,000, and credit finished goods, $30,000, to recognize the cost of these goods. We debit accounts receivable for the amount that we sold them for. It's on accounts. So this is $46,000, and we credit sales revenue, $46,000. So part 2 of the question asks to determine whether there was over or under applied overhead, and to show the T account for overhead. So we put in the overhead control T account. The actual overheads will appear on the debit side, and the applied overhead appears on the credit side. So based on our previous calculations, the applied overhead, we can pop that into the credit side as $14,700. The debit side, our actual overheads, include the factory rent, $9,500, electricity, $2,000, depreciation of factory equipment, $4,000. So our actual overheads total to $15,500. Our applied overhead was $14,700. So we have under applied. We have applied less than was equal to the actual. The difference is $800, and that's going to appear in the credit side, because we need to top up essentially that account to balance out the debits to be equal to credits. So we put in $800 under applied in on the credit side, and that's the amount that we've calculated. Part C of the question asked us to calculate the ending balances for each of the following accounts: raw materials, work in process, and finished goods. And we're told the beginning balances of each account. So the raw materials T account, we set it up with the opening balance on the debit side, $5,170. We put in from information part A the accounts payable purchases, $23,175. So we can total up our debit side. It's equal to $28,345. Our credit side, we've got work in process, $19,000, which we transferred out. So transferred to the factory floor. So $19,000 minus from the sum of the debit side gives us the closing balance of $9,345. Next, the work in process account. So opening balance $11,200. We put in the raw materials, $19,000. Wages payable, $17,850. Overhead control, $14,700. So we can total up the debit side. That's $62,750. The credit side, we have a transfer to finished goods, those goods that were finished during the period, and we're told that in part F. So $36,085. So that finished goods transfer minus from the sum of the debit side gives us the closing balance, $26,665. So the last T account, finished goods, we put the opening balance, $2,630 on the debit side. We put that transfer in from work in process, $36,085. Then we can add up the debit side, $38,715. The credit side, we're going to put in the amount that we transferred to cost of goods sold, $30,000. So minus that $30,000 from the sum of the debit side gives us a closing balance of $8,718. So part 4 of the question asks us to assume that the overhead variance was material and to write the journal entry for the reconciliation of these overhead costs and the cost of goods sold balance. So if the variance is material, that means we need to spread the overhead that was underapplied of 800 over the three accounts of work in process, finished goods, and cost of goods sold. If it was immaterial, we would focus solely on cost of goods sold. So in order to do this calculation, we need to write out the ending balances, and we set up a little table to do this calculation. So work in process, we pop in the ending balance, finished goods, pop in that ending balance, and cost of goods sold. Then what we do is we add up the total of the ending balances. This comes to 65,383. So our pro rata calculation is what we do in the next column. So we take that ending balance of work in process, 26,665, and divide it by the total of the sum of the three ending balances. This gives us the proportion to spread of the $800 overhead underapplied to work in process account. So we calculate this to be 326. Finished goods, we do the same. We take its ending balance, divide it by the sum of the three ending balances. This gives us 107. Cost of goods sold, we divide its ending balance by the sum of the three balances, multiply by 800, gives us 367. We can add up the amount that we distributed to all three accounts, and it comes to 800. This means that we have distributed that overhead underapplied across all three accounts. The journal entry to record this is going to have a credit side, a credit to overhead control, because in order to close off and make that overhead account a zero balance, we needed to put the amount in on the credit side because it was underapplied. So the journal entry is going to have a credit to overhead control of 800. The debit side parts of the entry is going to be debit work in process 326, debit finished goods 107, and debit cost of goods sold 367. So we've distributed that 800 overhead variance across all three accounts. Part 5 of the question asks, given that we know that the actual overhead costs at the end of May, why did we have to reconcile the actual with the expected overhead costs at the end of June? So the answer to this is that we use those expected overhead costs to calculate overhead that is applied much earlier in the period, and in turn it can allow us the costing of the goods much earlier. So we didn't have to wait until the end of the period to find out the actual overheads to do all of our calculations. So if we can determine our cost of goods sold earlier, as a manufacturer, we typically calculate our selling price based on cost of goods sold. So the earlier we have that cost of goods sold information, the earlier we can determine the selling price.